Partnership by T.T. Wathong Prasert Singh 109006253. Topic outline. Partnership formation. Partnership profit or loss. Partner admission. Partner withdrawal. Partner liquidation. Partnership formation. What is partnership? A partnership is an unincorporated association of two or more people to pursue a business for profit as co-owners. Partnerships are common in small retail and service businesses. Many professionals, including physicians, lawyers, and accountants, organize as partnerships. Characteristics of partnerships. Voluntary association. Partnership agreement. Limited life. Taxation. Mutual agency. Unlimited liability. Co-ownership of property. Voluntary association. A partnership is a voluntary association between partners. Steve Jobs, Steve Wozniak, and Ron Wayne were partners who voluntarily created Apple. Partnership agreement. Forming a partnership requires that two or more people agree to be partners. Their agreement is a partnership contract. Partnership contract. Although it should be in writing, the contract is binding even if it is only expressed verbally. Partnership agreements normally include partners. 1. Names and contributions. 2. Rights and duties. 3. Sharing of profit and losses. 4. Withdrawal arrangement. 5. Dispute procedures. 6. Admission and withdrawal procedures. 7. Rights and duties in the event the partner dies. Limited life. The life of a partnership is limited. Death, bankruptcy, or any event that disables a partner ends a partnership. Any one partner can end a partnership for any reason. Taxation. A partnership does not pay a business income tax. The profit or loss of a partnership is allocated to the partners and is taxed on each partner's return. Partners are taxed whether or not cash is distributed. Mutual agency. Mutual agency means that each partner can bind the partnership to contracts. Example. A partner in a retail store can sign contracts to buy merchandise, lease a store building, borrow money, or hire employees. A partner in a law firm, acting alone, however, cannot bind the other partners to a contract to buy snowboards for resale or rent an apartment for parties. Mutual agency exposes partners to the risk of unwise actions by any one partner. Unlimited liability. Unlimited liability means that when a partnership cannot pay its debts, creditors usually can take partners' personal assets. If a partner does not have enough assets to settle their share of the partnership debt, creditors can take the assets of the other partners. Co-ownership of property. Partnership assets are owned jointly by all partners. Any investment by a partner becomes the joint property of all partners. Partners have a claim on partnership assets based on their capital account in the partnership contract. Organizations with partnership characteristics. General partnerships. Limited partnership. Limited liability partnerships. S corporations. Limited liability companies. General partnerships. Entities where all partners have mutual agency and unlimited liability are called general partnerships. Limited partnerships. Individuals who want to invest in a partnership, but do not want the risk of unlimited liability, form a limited partnership. Limited partnerships. This type of organization is identified with limited or LP. A limited partnership has general and limited partners. At least one partner must be a general partner, who has management duties and unlimited liability for the debts of the partnership. The limited partners have no personal liability beyond the amounts they invest in the partnership. Limited liability partnerships. A limited liability partnership, or LLP, protects innocent partners from malpractice or negligence claims resulting from the acts of another partner. When a partner provides service resulting in a malpractice claim, that partner has personal liability for the claim. The partners not responsible for the claim are not personally liable for it. Accounting for an LLP is the same as for general partnership. S corporations. Certain corporations with 100 or fewer owners can choose to be treated as a partnership for income tax purposes. These corporations are called S corporations, which are different than C corporations. The advantage of an S corporation is that it does not pay corporate income taxes. If owners work for an S corporation, their salaries are treated as expenses of the corporation. S corporations. S corporations provide owners the same limited liability feature that C corporations do. The advantage of an S corporation is that it does not pay corporate income taxes. If owners work for an S corporation, their salaries are treated as expenses of the corporation. The remaining profit or loss of the corporation is allocated to owners and included on their personal tax returns. Except for C corporations having to account for income tax expenses and liabilities, account is the same for both S and C corporations. Limited liability companies. A limited liability company, or LLC, has some features similar to a corporation and others similar to a limited partnership. The owners, who are called members, have limited liability and can have management duties. For income tax purposes, an LLC is typically treated as a partnership. Choosing a business form. Choosing the proper business form is crucial. Many factors should be considered, including taxes and liability risk. The following table summarizes important characteristics of different business partnership entities. Accounting for a partnership formation. Uses a capital accounting involves for each partner. Uses a withdrawals account for each partner. Allocates net profit or loss to partners according to the partnership agreement. Dividing partnership profit or loss. Allocation on stated ratios. Allocation on capital balance. Allocation on services, capital, and stated ratios. Allocation on stated ratios. The stated ratio, also called the profit and loss sharing ratio, the profit and loss ratio, or the P&L ratio, method of allocating partnership profit or loss gives each partner a fraction of the total. Partners must agree on the fractional share each receives. For example, Zane and Perez agree that Zane receives 2/3 and Perez 1/3 of partnership profit and loss. If their partnership's net profit is $60,000, it is allocated to the partners when the income summary account is closed as follows. Allocation on capital balance. The capital balances method allocates profit and loss based on the ratio of each partner's relative capital balance. The journal entry follows the same format as that using stated ratios. Allocation on services, capital, and stated ratios. The services, capital, and stated ratio method is often used when partners' service, time, and capital contributions are not equal. Salary allowances are given to partners who spend more time working for the business. Interest allowances are given to partners who made larger capital contributions. Salary and interest allowances are not reported as expenses on the income statement. They are simply a way of dividing partnership profit or loss. Assume that Zane and Perez's partnership agreement has differences in service and capital contributions as follows. 1. Annual salary allowances of $36,000 to Zane and $24,000 to Perez. 2. Annual interest allowances of 10% of a partner's beginning year capital balance, and 3. Equal share of any remaining profit or loss. The following two examples use this 3-point allocation agreement. When profit exceeds allowances. If Boards has first year net profit of $70,000, profit is allocated as shown in the slide. Zane gets $42,000 and Perez gets $28,000 of the $70,000 total. When allowances exceed profit. The allocation agreement is followed even if net profit is less than the total of the allowances. For example, if Boards' first year net profit is $50,000 instead of $70,000, it is allocated as shown in the slide. Salary and interest allowances are identical to those in previous slide. After allowances, the $14,000 negative balance is allocated equally to the partners per their sharing agreement. This means that a negative $7,000 is allocated to each partner. In this case, Zane ends up with $32,000 and Perez with $18,000. Partnership financial statements. Partnership financial statements are similar to those we already covered. The statement of partners' equity, or statement of partners' capital, is one exception. It shows each partner's beginning capital balance. Partner admission. A new partner is admitted in one of two ways. By purchasing an interest from one or more current partners, or by investing cash or other assets in the partnership. Purchase of partnership interest. The purchase of partnership interest is a personal transaction between one or more current partners and the new partner. To demonstrate, at the end of Boards' first year, Perez sells one half of his partnership interest to Tyrell Rashid for $18,000. This means that Perez gives up a $13,000 recorded interest, $26,000 times half, in the partnership. The partnership records the purchase of partnership interest as follows. Investing assets in a partnership. Admitting a partner by accepting assets is a transaction between the new partner and the partnership. The invested assets become partnership property. To demonstrate, if Zane, with a $52,000 interest, and Perez, with a $26,000 interest, agree to accept Rashid as a partner in Boards after an investment of $22,000 cash, this is recorded as follows. After this entry is posted, both assets, cash, and equity T. Rashid, capital, increase by $22,000. Rashid now has a 22% equity in the assets of the business, computed as $22,000 divided by the entire partnership equity, $52,000 plus $26,000 plus $22,000. Rashid does not necessarily have a right to 22% of profit. Dividing profit and loss is based on a separate agreement. Bonus to old partners. When the current market value of a partnership is greater than the recorded amounts of equity, the partners usually require a new partner to pay a bonus to join. When the balance in the new partner's capital account does not equal the amount of net assets invested, the difference is called a bonus either to or from the current partners. Assume that Zane and Perez agree to accept Rashid as a partner with a 25% interest in Boards if Rashid invests $42,000. Recall that the partnership's accounting records show that Zane's recorded equity in the business is $52,000 and Perez's recorded equity is $26,000. Rashid's equity is determined as follows. Although Rashid invests $42,000, the equity attributed to Rashid in the new partnership is only $30,000. The $12,000 difference is called a bonus and is allocated to existing partners according to their profit and loss sharing agreement. A bonus is shared in this way because the market value of the partnership is greater than the recorded equity. The entry to record this transaction follows. Bonus to new partner. Alternatively, existing partners can give a bonus to a new partner. This usually occurs when they need additional cash or the new partner has exceptional talents. The bonus to the new partner is in the form of a larger share of equity than the amount invested. Assume that Zane and Perez agree to accept Rashid as a partner with a 25% interest in the partnership, but they require Rashid to invest only $18,000. Rashid's equity is determined as follows. The old partners contribute the $6,000 bonus, $24,000 to $18,000, to Rashid according to their profit and loss sharing ration. The entry to record the admission and investment of Rashid is Partner withdrawal. First, the withdrawing partner can sell their interest to another person who pays for it in cash or other assets. For this, we debit the withdrawing partner's capital account and credit the new partner's capital account. Second, cash or other assets of the partnership are distributed to the withdrawing partner in payment of his or her interest. No bonus. If Perez withdraws and takes cash equal to Perez's capital balance, the entry is in the slide. Bonus to remaining partners. When a withdrawing partner takes less than the recorded value of his equity, they are in effect giving the remaining partners a bonus equal to the equity left behind. The bonus is distributed according to their profit and loss sharing agreement. To demonstrate, if Perez withdraws and agrees to take $34,00 cash in payment of his capital balance, the entry follows. Perez withdraws $4,000, less than his recorded equity of $38,000. This $4,000 is divided between Zain and Rashid according to their profit and loss sharing agreement. Bonus to withdrawing partner. When a withdrawing partner receives more than the recorded value of his equity, they are in effect receiving a bonus. The remaining partners reduce their equity by the amount of this bonus according to their profit and loss sharing agreement. To demonstrate, if Perez withdraws and receives $40,000 cash in payment of his capital balance, the entry is like in the slide. Death of a partner. A partner's death dissolves a partnership. A deceased partner's estate receives that partner's equity. The partnership contract should state how to deal with the death. This can involve selling the equity to remaining partners or to an outsider, or it can involve withdrawing assets. Liquidation of a partner. First, record the sale of assets for cash, and any gain or a loss is allocated to partners using their profit and loss sharing agreement. Second, pay all partner liabilities. Third, distribute any remaining cash to partners based on their capital balances. Partnership liquidation usually falls into one of two cases, as described in this section. No capital deficiency. No capital deficiency means that all partners have a zero or credit balance in their capital accounts for final distribution of cash. Assume that Zain, Perez, and Rashid operate their partnership and boards for several years, sharing profit and loss equally. The partners then decide to liquidate. On the liquidation date, the current period's profit or loss is transferred to the partners' capital accounts according to the sharing agreement. After that transfer, assume the partners' recorded account balances, immediately prior to liquidation, are in the slide. We apply 3 steps for liquidation. First, the partnership sells its assets, and any losses or gains are shared among partners according to their profit and loss sharing agreement, equal for these partners. Assume that Boards sells its assets consisting of $40,000 in land for $46,000 cash, creating a net gain of $6,000. In a liquidation, gains or losses resulting from the sale of non-cash assets are called losses and gains from liquidation. The entry to sell its assets for $46,000 follows. Allocation of the gain from liquidation per the partner's profit-loss sharing agreement follows. Second, the partnership pays its liabilities, and any losses or gains from the liquidation of liabilities are shared among partners according to their profit and loss sharing agreement. Boards' only liability is $20,000 in accounts payable, and no gain or loss occurred. After step 2, we have the following capital balances along with the remaining cash balance. Third, any remaining cash is divided among the partners according to their capital account balances. The entry to record the final distribution of cash to partners follows. It is important to remember that the final cash payment is distributed to partners according to their capital account balances, whereas gains and losses from liquidation are allocated according to the profit and loss sharing ratio. The following statement of liquidation summarizes the 3 steps in this section. Capital deficiency. Capital deficiency means a partner has a debit balance in their capital account at the point of final cash distribution, during step 3 in the prior section. This comes from liquidation losses, large withdrawals before liquidation, or recurring losses in prior periods. A partner with a capital deficiency must pay cash into the partnership. Assume that Zain, Perez, and Rashid operate boards for several years, sharing profit and losses equally. The partners then decide to liquidate. Immediately prior to the final distribution of cash, the capital balance is Rs. Ain, $19,000, Perez, $8,000, and Rashid, $3,000. Rashid's capital deficiency means that Rashid owes the partnership $3,000. The final distribution of cash depends on if the partner pays the deficiency or the partner cannot pay the deficiency. Partner pays deficiency. If Rashid is able to pay the $3,000 deficiency, the entry to record receipt of payment from Rashid follows. After the $3,000 payment, the partner's capital balance is Rs. Ain, $19,000, Perez, $8,000, and Rashid, $0. The entry to record the final cash distributions to partners is like in the slide. Partner cannot pay deficiency. The remaining partners with credit balances absorb any partner's unpaid deficiency according to their profit and loss sharing agreement. If Rashid is unable to pay the $3,000 deficiency, Zain and Perez absorb it. Because they share profit and loss equally, Zain and Perez each absorbs $1,500 of the deficiency. This is recorded as follows. After Zain and Perez absorb Rashid's deficiency, the capital account Rs. Ain, $17,500, Perez, $6,500, and Rashid, $0. The entry for the final cash distribution to the partners is as in the slide. Partner return on equity. The partner return on equity ratio helps current and potential partners evaluate the success of a partnership compared to other investments. Case study. Background. 3 friends, Alex, Ben, and Chris, decide to start a business together. They plan to open a cafe in their neighborhood. Each partner brings unique skills and resources to the venture. Alex is an experienced chef, Ben has expertise in managing finances, and Chris has connections with local suppliers. Formation of the partnership. The partners agreed to form a general partnership named ABC Cafe. They contribute capital to the business in the following amounts. Alex invests $50,000 in cash. Ben contributes $30,000 in cash. Chris contributes equipment worth $20,000 and $10,000 in cash. Partnership agreement. They draft a partnership agreement outlining the terms of their collaboration. The agreement specifies the following: profit and loss sharing ratio. Alex equals 40%, Ben equals 30%, Chris equals 30%. Salaries. Alex will receive a monthly salary of $3,000, Ben $2,500, and Chris $2,000. Decision making. Major decisions require unanimous vote, while routine operational decisions can be made by any partner. Dispute resolution. Disputes will be resolved through mediation, and if necessary, arbitration. Operations and accounting. ABC Cafe begins operations, serving customers and generating revenue. They maintain detailed financial records using double entry accounting. Transactions are recorded for purchases, sales, salaries, and expenses. The partners regularly review financial statements, including the income statement, balance sheet, and cash flow statement. Distribution of profits. At the end of the fiscal year, ABC Cafe reports a net profit of $100,000. According to the profit sharing ratio, the profits are distributed as follows. Alex, $40,000. Ben, $30,000. Chris, $30,000. Taxation. As a partnership, ABC Cafe is not subject to income tax at the entity level. Instead, each partner reports their share of profits or losses on their individual tax returns. They receive a Schedule K-1 from the partnership, which outlines their distributive share of income, deductions, and credits. Expansion and future plans. As the cafe grows in popularity, the partners consider expanding their business by opening additional locations or diversifying their offerings. They continue to work collaboratively, leveraging their individual strengths to drive success for ABC Cafe. conclusion. This case study highlights the formation, operations, and accounting practices of a partnership in the context of a small business venture. Partnerships offer flexibility, shared responsibility, and the ability to leverage complementary skills and resources for mutual benefit. Clear communication, trust, and a well-defined partnership agreement are essential for the success of the business and the harmony among partners. Strength. Complementary skills and resources. Each partner brings unique expertise to the partnership. Alex contributes culinary skills, Ben offers financial management expertise, and Chris brings connections with suppliers. This diversity of skills enhances the overall capability of the business. Shared decision-making. The partnership agreement allows for shared decision-making, ensuring that major decisions are made collectively, while routine operational decisions can be handled efficiently by any partner. This promotes collaboration and fosters a sense of ownership among the partners. Flexible structure. As a general partnership, ABC Cafe benefits from a flexible organizational structure with minimal formalities and regulatory requirements. This allows for quick decision-making and adaptability to changing market conditions. Tax advantages. The partnership structure allows profits to be passed through to individual partners, who are then taxed at their individual tax rates. This can result in tax savings compared to other business structures, such as corporations. Weakness. Unlimited liability. Each partner in a general partnership is personally liable for the debts and obligations of the business. This exposes the partner's personal assets to potential risks associated with the business, which could be a significant downside, especially if the business encounters financial difficulties. Potential for conflict. Despite having a partnership agreement in place, conflicts among partners can still arise, especially regarding decision-making, profit distribution, or the direction of the business. Resolving these conflicts effectively requires open communication and compromise. Dependency on partners. The success of the business relies heavily on the contributions and commitment of each partner. If one partner becomes unable or unwilling to fulfill their obligations, it could impact the operations and growth of ABC Cafe. Limited growth potential. General partnerships may face limitations in raising capital compared to other business structures, such as corporations. This could restrict the ability of ABC Cafe to pursue expansion opportunities or invest in new initiatives. Opportunities. Market expansion. As the cafe grows in popularity and establishes a loyal customer base, there may be opportunities to expand to new locations or introduce additional products or services. This could fuel revenue growth and increase market share. Diversification. ABC Cafe could explore diversification opportunities, such as offering catering services, hosting events, or selling branded merchandise. Diversifying revenue streams can reduce reliance on a single source of income and mitigate risks. Partnership alliances. The partners could explore strategic partnerships or alliances with other businesses in the food and beverage industry. Collaborating with suppliers, distributors, or complementary businesses could create synergies and unlock new opportunities for growth. Technology integration. Embracing technology, such as online ordering systems, mobile payment solutions, or digital marketing platforms, can enhance customer experience, streamline operations, and drive efficiency. Threats. Competition. The food and beverage industry is highly competitive, with numerous cafes, restaurants, and eateries vying for customers' attention. Competing establishments may offer similar products or services, lower prices, or better amenities, posing a threat to ABC Cafe's market position. Economic uncertainty. Economic downturns, fluctuations in consumer spending, or unforeseen events, for example, pandemics, natural disasters, can adversely affect the hospitality sector, including cafes and restaurants. Economic uncertainty may impact consumer behavior and discretionary spending, affecting ABC Cafe's revenue and profitability. Regulatory compliance. Compliance with health, safety, and food regulations is essential for operating a cafe. Changes in regulations or non-compliance with existing regulations could result in fines, penalties, or reputational damage to ABC Cafe. Staffing challenges. Recruiting and retaining skilled staff, including chefs, servers, and baristas, can be challenging in the competitive labor market. Staff turnover or shortages could disrupt operations and impact service quality, customer satisfaction, and ultimately, the success of the business. SWOT. Conclusion. Overall, while the partnership formed by Alex, Ben, and Chris has several strengths and opportunities, it also faces weaknesses and threats that need to be carefully managed to ensure the long-term success and sustainability of ABC Cafe. Effective communication, strategic planning, and proactive risk management are critical for navigating these challenges and capitalizing on growth opportunities. Thank you for listening. Don't hesitate to ask any questions.